Hi, everyone. This is Bob Carillia. I'm one of the partners at Rizolve Partners, and my guest today and partner is Steve Cummings, who is the founder and the managing partner at Rizolve. How are you doing today, Steve?
I'm very good. I'm very good, Bob. Thank you.
Perfect. It's a beautiful, snowy, white winter day up here in north of Toronto. I'm sure the same where you are. Perfect. So what we wanted to do today is we wanted to talk about, what are the impediments to an entrepreneur or the owner of a small business selling their business? And one of the thoughts that I had was, why don't I go out into the wide world of AI and ask ChatGPT what it thinks the five biggest issues are, the biggest impediments are to an entrepreneur selling their business. So I asked that question, and what I'd like to do is just, Steve, I'm going to throw these questions up for discussion from the two of us. But they came up with five options here, and the first one was one of the biggest impediments is the overvaluation or unrealistic price expectations on the part of the entrepreneur. What are your thoughts on that?
Well, I think that's absolutely one of the biggest impediments, and we certainly advise our clients and prospects that certainly having the correct expectations with regard to the value of your business is very important to understand going into a process, not least of which from the point of view of a happy outcome with regard to satisfaction with the conclusion at the end of the day. But certainly the expectations need to be set correctly. We at Rizolve think that that is one of the prime value adds that we can bring to the table for business owners. The market has, interestingly, a range of value that it will apply to a particular size of business in a particular segment with particular specialisms and so on. It has a range of value that it will ascribe to those businesses, and perhaps the range of value is part of the discontent that some business owners have. I'll give you an example, Bob. And we often give this example in a workshop to illustrate the range of value. If you had two similar businesses of the same size, the same complexity, the same market they're addressing, and in many respects could be looked at as similar businesses. The delta between similar businesses, when you look at one end of the range of value versus the opposite end of the range of value, can be quite different. In actual fact, the data that we often put in front of people that we talk to about this, the delta can be as much as 70% in the lower mid-market. We have data that we put on the table to that effect. So actually, for a business owner to understand the quality of the assets that they've put together, and by that what I mean is the quality of the human resources, the quality of the processes, the quality of the tools that they have instigated and work with, and the quality of the systems and so on. All of those things, when put together, speak to the quality of the business that they've and the quality, depending on how those things have been put together, they're either good or not so good, speak to the range of value. So Bob, I would actually agree with AI on this one. Is it number 1, 2, or 3? It's very high up on the list, and it's a big issue. And the way we recommend business owners are addressing this is to get educated. Get educated early, and in addition to that, you will need a group of advisors advising you on how to proceed and how to understand the quality of the business that you put together from a market perspective.
Right. Yeah. No, you're absolutely right. This was number one that came out from AI. So let's move on to number two, and this is right up your alley. ChatGPT said that number two was weak financial records or lack of transparency in those records. So you've certainly dealt with this over your 30 plus year career. What are your thoughts on that?
Well, your financial records are really just a testimony to how well the business performs. They happen to be one of the prime pieces of evidence that any buyer would look at in order to try to assess what the value of the company is and put a price on that. So whichever way you look at it, financial records are very important. Whether you have complied and are up to date with all of your tax obligations and so on, the accuracy of those declarations with CRA, be it corporation tax or be it HST, are all predicated on the quality of your financial reporting. So if you've got high quality in your financial reporting, then your compliance responsibilities, hopefully with good advisors, good accounting advisors, means that you've would imply that you've dealt with your obligations and discharged them properly. So weak financial records are in terms of track record, historical track record. They indicate how well the business has performed, the growth rate, and so on. They will be subject to a high degree of due diligence from a buyer, be it professional buyer or another business owner. And the rider to the trust that a bidder has in the financial records, the rider to all that is also making sure that you're transparent in the information that you give during the due diligence. It is very important. Any broker or investment banker handling the sale process will tell you that being open and honest is the best way to get to a fair price being negotiated. And in the absence of that, there will be cuts in the sale price or a failure to transact. So I do think, and again, not I think it's table stakes, frankly, Bob, absolutely table stakes. Good financial records and transparency, and indeed being able to explain, segmenting the data in order to justify where growth comes from, is all very important to being able to satisfy a bidder that the price they're bidding is a good deal to be done.
Yeah. No, I really like where you're going there. I mean, transparency is such a critical one. It's one thing to have great financial records, but you've really got to be forthcoming because you're asking someone to invest money into your business, and your financial records are the door to understanding how the business is working. So being transparent and forthcoming about not only what the numbers say, but how those numbers are developed, I think is critical. You're absolutely right.
So I've done a lot of talking, Bob. Maybe we'll put you in the hot seat right now.
Well, number three is actually one that I like to talk about, and it's dependence on the owner. And I can speak to that from the sales perspective. Very often you see a small business started by an entrepreneur or a very, hands-on owner. And from a sales perspective, they are the lead salesperson. They close the most business. They are out there. They're so passionate about their business, and they've created this business that they become the primary source of revenue for the company. But you can see the challenge there. If that same individual is looking to ultimately sell their company and step away from the business, how much of that revenue would step away or would leave, if that owner wasn't there, if they are the primary salesperson in the organization? And that's from the sales perspective, but it also follows through. If that individual is the brain trust behind how the business operates, or the IP in the business, the intellectual property in the business, those are also challenges, because that knowledge is going to leave, maybe not immediately, maybe there's some sort of an agreement that the owner stays on for 6 months or something like that. But ultimately, that knowledge and that passion and that experience is going to leave when the owner steps away from the business. So if they are the only one who are selling, if they're the only one who understand the operation, if they're the only ones who understand the value proposition in the company, that's a problem. So I can see that being a big impediment.
But I think that's definitely in the top three for me, for sure. Depending on the size of the business, and even larger size businesses can be somewhat dependent on the owner, even if they have a diversified management team. But fundamentally, dependence on the owner, and once the owner is removed from the business, the question that needs to be answered is the business sustainable in the hands of a new owner without the existing? Is the performance of the business predictable from the point of view of ongoing operations in the hands of a new owner? And finally, is the business that is represented by the historical track record, is it repeatable into the future? And here's where recurring income comes in, and so on. So the business owner needs to be able to demonstrate that in his absence, for sustained periods of time, the business will perform in the way that it is represented. It will perform. And so non-reliance on the business owner, having built a system, a set of processes, and so on, that it will operate in third-party hands, and it's crucial to business value that is the case.
Yeah, no, absolutely. Interestingly as well, it's not always just the owner, right? It's, I've seen organizations where, again, back to sales, you have one salesperson who accounts for most of the sales. And that's not to say that they wouldn't transfer with the ownership of the business to the new owners. But again, you've got to make sure that the contracts are in place, that they're comfortable moving with with the change in ownership, because again, that's a risk if that individual doesn't follow, to the new ownership. So
Yeah.
as you say, transferability, big issue there.
Yeah, reliance on key employees is exactly the same issue. The key here is that the business can scale when needed by inserting incremental resources into the business, and those resources can operate a system and the tools and with the team in order to grow the company, and it is not reliant on any one individual.
Yeah.
And so, this is definitely, absolutely one of the top issues for selling a business.
Okay. Well, and number 4, of course, not to no surprise, is market conditions and timing. The whole issue of, do you sell in an economic downturn? Do you sell in times of uncertainties? You can, but boy, you've got to be prepared that there could be a very different view, if the market is down. So timing, like anything, timing is everything.
Yeah, I think with market conditions, good businesses will always sell. They will always sell. In down markets, risk aversion from investors goes up. They don't particularly like to see variations or unpredictable results coming out of the business model. They would discount that unpredictability heavily, which means that values in a tough market come down. So market conditions will mean that good quality companies that are independent, that have sustainable results, that are predictable into the future, will sell. However, if the market level comes down, then obviously values come down due to the risk aversion
Yeah.
as well.
Yeah.
So certainly market conditions is one of them that needs to be taken account of. But that's back now. Now, what we're really talking about with market conditions is the concept that we started off on of unrealistic expectations. When markets go up, then values generally can be expected to rise in when a business gets brought to market. But when the market goes down, that doesn't mean that your individual company value doesn't go down. That's part of the deal.
Right. Yeah. No, absolutely. Okay, well, let's take a look at the number five out of our top five. And again, not surprisingly, you alluded to this a little bit when we were talking about the financial results, but legal, tax, the complexity of the deal structure. ChatGPT basically says that that's number five on this list in terms of some of the impediments to making a sale happen.
Sure. Well, fundamentally, one of the things that we do with our customers is we plan for the exit. We're exit planners. That's one of the things that we do. And planning is important because there are oftentimes impediments to the deal that can be stepped over with time, but sometimes without time cannot be stepped over. For example, one of the typical deal blockers that you see is litigation that is going on, any litigation that's going on with the company. Another deal blocker could be over concentration of the customer base into the hands of one big customer. And typically big is more than 15% of your customer base. So if you've got a customer that's in the 50 to 60% of your revenue, that's highly concentrated. That represents real risk to a buyer. Why? Because if they conclude the transaction and a few months later that customer goes off because maybe the relationship's changed, but if that customer goes off to a new supplier, that's a massive hit to the cash flow and earnings of the company, which presumably the business, the buyer has paid for. So legal due diligence is absolutely going to be done by a buyer. They want to make sure that the reps and warranties are in place in order to protect themselves from any bad elements to the deal. They want to make sure there's no compliance issues embedded in the company. For example, poor tax reporting or inaccurate tax reporting, either on the payroll or on the HST or on the corporate tax side. They want to make sure that there's good governance been applied there on the tax side. And they want to make sure that on the legal side, there has been no disputes with any stakeholders that are unaccounted for in the records. And certainly the more complex the company, maybe there's cross-border relationships that have been set up. The more complex the company, the greater the focus on the risks of taking over those types of entities. So certainly when you're looking to pass the ownership, particularly in a share transaction, pass the ownership of the company into other people's hands. You know, all of the liabilities associated with the shares go with the transaction, and there's going to be a lot of due diligence to make sure that the legal, the tax, and any hidden complexities are brought to the fore and fully understood before a transaction is consummated. So that is definitely 5, Bob. But I just want to pick up a big one for me, and I mentioned it a short while ago. Big one for me is customer concentration, and the diversified nature of the customer base. The more concentrated that customer base, it could absolutely be a deal killer, depending on the nature of the relationship with your largest customer. If there's reliance on the owner with regard to that relationship, it can be problematic, and so on and so forth. So I guess looking at those 6 things, all of them very important, but for me, the top 3 are dependence on owner, customer concentration, and unrealistic valuation expectation of business owners. That they would be the top 3, in my opinion.
Well, and interestingly, when you take a look at all of these, and I'm sure we could find number 7, 8, 9, and 10. There's always these things that need to be addressed, and this is likely a topic for a future podcast. But making sure that all your ducks are in a row with respect to these issues that we've raised takes time. You can't do that in the spur of the moment. You can't do that within a couple of weeks. So again, likely this could be a topic for an entirely different podcast, but timing is also critical to make sure that you're in front of this. You give your exit planners and your your advisors time to put these things in place, is also critical. So again, we'll talk about that sometime in the future. But well, this is interesting, and I appreciate your insights into this, Steve. I think that can wrap up this today, but definitely you're giving some food for thought here to someone who is considering the transition of their business. There are some things that you've got to consider in advance before you go to market, because you definitely want to optimize the value of your company that you've worked so hard to build, and give yourself the time and give yourself the due diligence to make sure that you're getting the most for that hard-earned asset. All right, Steve, thanks so much. We'll call that a day, and join us again. We record these on a regular basis. Join us again at Rizolve Partners. And you can reach us at rizolve.ca, and Rizolve is RIZOLVE.ca. Always a pleasure talking to you, Steve, and we'll chat soon.
Bob, you need to turn it off because sorry. They'll be able to edit that